everybody really looks forward to is our Diwali interaction with Prashant Jain to understand his insights, where he expects there could be value migration in this market, where there are excesses in the market, and what about valuations and the earning mix. All that and much more on this Diwali special with none other than Prashant Jain. Mr. Jain, first, Diwali greetings to you and your team. The current Samvat year, even though last couple of days have been quite volatile and choppy, in general is a Samvat where massive wealth has got created in equities, real estate, and also gold.
Yes, Nikunj, you are absolutely right. And I wish you, your colleagues, and your viewers a very happy and prosperous new year ahead as well. And I would agree with what you said, though the current year looks to be one of moderation. And I think it is always good to have a moderate year after strong wealth creation, and it sets the base for future returns. So I think I would echo your sentiment. Yes.
Mr. Jain, you've been a big votary of mean reversion over the years. The way you've managed money both publicly and now for your private clients, you've always said that markets, they follow a cycle. Cycle means that there is mean reversion. If one has to assess this bull market cycle, where are we in this cycle? Are we anywhere closer to euphoria, bubble and a bust, or we are nowhere close to that part of the cycle?
Nikunj, I think it would be unfair to answer this question for whole markets because there has been considerable divergence between large caps and small mid caps. So I would say in large caps, we are very close to fair value. I think there is very little room, probably no room for multiples to move up. But I think we can by and large justify these multiples in aggregate terms for the large caps. I think the challenge for the markets, as me and many others have been highlighting for a while, is in the small and mid caps. And that is the space, I think, which is clearly ahead of fundamentals. The multiples are extremely rich. And I think in many places, the earnings will disappoint. So the downside in those spaces is what appears to be more. The risk reward is clearly in favor of large caps, in my opinion.
So are we going to go through that phase that for last 3 years we've used the word a secular bull market? It was a rising tide phenomenon. Now it is going to be a differentiated market where a bull market and a bear market, they would coexist. Within a sector, some banks are delivering, some banks are not delivering. Within IT, the same trend. Within auto, the same trend. Are we going to go through what really could be called as a non-secular bull market where very few stocks
So I
will
think
go
that
higher?
is, yeah. Yes, I think Nikunj, the dispersion in future performance should be probably more in these markets because valuations are by and large quite reasonable, not much upside. In aggregate terms, multiples are fair. But I think as results come out, as growth disappoints or is in line or exceeds expectations, I think the divergence in performance across sectors and across individual businesses could be more going ahead. You are right.
What do you make of the current leg of the earnings season? We are getting more downgrades, hardly any upgrades. Even though economy is growing at 8%, there seems to be a struggle when it comes to individual companies and the kind of commentary we are getting from autos to FMCG, from consumer to even consumer discretionary. All companies are now struggling. Why is that? If the economy is growing, then why why earnings are contracting?
But I think there can be some differences between economic cycle and business cycles, and that is what we are experiencing here. And we have actually been sharing, suggesting that the profit growth rates need to come down very sharp. See, there are two things here. One, the overall economy, while the real growth is 6 to 7%, India is now a lower inflation economy. So our inflation is broadly 4 to 5%. So which means your rupee GDP, nominal GDP is growing around 10-11% a year. So longer term earnings need to align with that lower inflation environment, lower nominal GDP growth rates. The last 5 years earnings were supported massively because corporate profitability base or margins were extremely low post COVID. We have seen a complete recovery in corporate profitability, in corporate margins. Our aggregate corporate profitability is very close to previous peaks. So I think future profit growth to margin upside appears to be limited, especially in most of the sectors. So I think in aggregate terms, one would expect profit growth to be around 12 odd percent over next few years. I think regarding the sectors which you mentioned, consumer oriented sectors, I think what one has seen over last few years, and we have written about this also, that the consumption in last few years was supported by rising retail leverage, by rising household leverage. And I mean, it's very logical whenever you borrow and spend, at some point in the future, you have to slow down. So I think that is the phase that what we are experiencing. I would not worry too much about this from a medium term perspective, but near term, you are right that the consumer demand appears to be somewhat weak.
The script of how Indian markets have moved has been deeply influenced by local flows, be it HNI investors, family office, or the SIP investors. Uh, when you have such a large inflow, which looks like is a committed flow for in the near term, how do you see market reacting? Because even the FIs are selling, the local flow is making all the difference.
No, you are right, absolutely, Nikunj. But what you also need to add to that equation is the supply of new stock. So the IPOs, the NFOs, the sell downs, I think is very significant. It is very large, and you are seeing multiple billion-dollar IPOs getting concluded in the recent past. In the future, many are in the pipeline. So I think, and that is so the source of supply is twofold: the foreigners and the new stock supply. And this is the reason why I think markets have corrected.
You've been echoing your thoughts on small and mid cap. It's taken almost a year for markets to realize that there was euphoria and bubble there, and now these stocks have started correcting. Where are mid caps headed? And within mid cap, where do you think the vulnerability to valuation is the highest?
Think, Nikunj, I think yes, we have experienced this many times in the past also that what is expensive can become more expensive, and what is cheap can become cheaper because before mean reversion sets in. So I think the significant wealth creation, small mid caps, because of the extremely low base set during COVID, create higher wealth if measured from that point of time. And that is why a lot more people participated in that. And that is what has led to sustained outperformance. In that space, I think that cycle seems to be changing now. So I would say that the multiples in small mid caps, generally speaking. See, the universe of small mid caps is so large, runs into many, many hundreds of companies, probably even more, that there will always be some businesses, one in 10, one in 20, which can outperform even in this type of a market. But by and large, I would be cautious in the small mid cap space. And I think earnings can disappoint, multiples are very high, supply of new stocks by way of new companies coming to the market is also quite high. And once the momentum breaks in a place where there are excesses, valuations are ahead of fundamentals, it is unlikely that this trend will reverse in a hurry. That is what one has seen in the previous cycles.
So, going by what your newsletter is and what you've been expressing, can I, before I move to themes and sectors, can I say that the prudent strategy, according to you, of course, each one has to look at their own risk profile, but the prudent strategy, according to you, is not to sell out of equities, but perhaps within equities, move from small and mid cap to large cap?
So I think this is a market where one should reset one's return expectations. I think that is most important. I think if we expect low double digit returns from Nifty over 3 5 years, I think these are realistic expectations. I don't think we should continue to expect higher returns from small mid caps. That would be a wrong expectation, in my opinion. See, the way I see Indian equities, if you look at annual returns of equities. A 10-15% volatility in equities is very normal, even without anything significant happening. And once in a while, when there is a crisis year, let's say it was Lehman or 9/11 or COVID, the falls can be sharper. So I think you should invest that much in equities, remain invested, on which you can tolerate these kinds of volatility and expect. But yeah, I think the key is to tone down your return expectations. People don't get excited by a 12% CAGR in equities. But I think that's it can create significant wealth if you invest with those returns for longer periods of time. And in any case, I think those are the likely returns in my opinion. Also, one cannot ignore the significant difference in taxation between equities and fixed income. So, at 5% post tax returns on fixed income, it will take 14 years to double your money. But in equities, I think we can probably double money, at least in large caps, over a 6 years or so, or over 14 years, 100 becomes 500 in equities. I think that type of an approach, that type of expectation should be the right one for equities.
Okay, I'll now move to the next leg, and I just want to bring this out for the benefit of our viewers that I've had the pleasure of interacting with Mr. Jain for almost 2.5 decades now. His ability to really find value in this market and really ahead of the curve is quite extraordinary. For example, PSUs, corporate banks, identifying manufacturing, staying out of IT when there was absolute bubble and trouble there, avoiding mid caps in 2014-15. These have been some of his classic calls. And in COVID, well, he went all out on ET now. I distinctly remember when he said that it's time to buy the fear because stocks were available, gold was available at the price of silver. So let's take that theme forward. Where do you think this market right now is offering value for a value investor like Prashant Jain?
Yeah, I think first and foremost, this is a market where there are, to my mind, no pockets of deep value. So up till now, what one has seen in different cycles, that some pocket or the other was deeply undervalued, whether it was non-tech in 2000, whether it was non-infra in 2007, whether it was, PSUs, corporate banks, Capex, manufacturing few years back, utilities, etc. In this market, deep value is hard to come by, to my mind, and one has to be satisfied with compounding returns, as we discussed earlier. Yet, on a relative sense, I feel the banks are offering relatively better value, and that is what has been the case for some time. I think there the while earnings growth will be in low to mid teens, I think there is some scope, a limited small scope for multiples to re-rate as well. At least the multiples don't appear to be excessive. Chances or room for a de-rating in multiples is probably not there. So I think that would be the most preferred place to my mind.
But if the economy slows down, is it a good idea to buy into banks? Because there are cracks which are opening up, be it private banks or small banks or even banks which have exposure to microfinance. Without getting into specifics of names here, but the banking numbers so far have not really been extraordinarily satisfactory. They are feeling the heat of the economic slowdown.
So I don't think the economy is slowing down, but I do feel that consumption is a bit slow. And at some point, it was bound to happen because household leverage has gone up significantly. And even the central bank is somewhat concerned with that. And you are right, when consumer leverage is high, the most vulnerable pockets of consumer lending will suffer some slippages. So we are seeing some higher slippages in MFI loans, in unsecured personal loans, in credit card loans. So I would prefer the large banks where the exposure to these segments is extremely small.
That there's continuous FI selling and FI largely have a large exposure to banks. Could that be a limiting factor? And also Manish Chokhani of Inam told me that financials have a combined market cap of $1 trillion in a market which is about $4.5 trillion. Won't that be a concern? Because if this sector is already commanding a jumbo market cap, then it will be difficult for this sector to go against the FI selling.
Oh, you are right, and the FI selling has been going on for few years now. Which so this was the most popular, the most overowned sector in India for many, I would say, probably few decades. And but we have seen considerable sell downs happening in this space, and so I still feel that if you take a slightly longer term view, this space has see the derating of this sector has taken place because of two reasons. One, growth has slowed down, and there has been consistent selling by foreign institutions. But today's valuations, I think, align well with the current or likely growth rates of this sector.
Prashant, one other theme which you identified was power. And I want to remind our viewers, his thesis was centered around the fact that power capacity has not come. The world is focusing on ESG. Thermal capacities have not kicked in. Indian power sector, Indian power demand is going higher. What are your thoughts there? And within power or energy migration, would you stick to utilities, or there are some other pockets of opportunity?
I think that's a well understood, well discounted theme now. And this theme was offering great value few years back. I think while it offers growth still, but I think valuations are full. So I would not be hopeful of a re-rating in this space. In fact, given the very nature of this space, the ROEs are very controlled, and this is neither a high growth sector nor a high ROE sector. So I think the current valuations are quite in line with the underlying fundamentals.
So, Prashant, there are a lot of popular themes in the market: energy transition, AI, EV. Where do you think the next big wave of earnings is coming?
I don't think there is, see, the transition towards renewable is, yes, the renewable companies will grow, but you have to be cautious. How sustainable are those earnings? And what are we paying for those earnings? And as I had said earlier, at least in terms of power generation, the existing utilities, large utilities that are able to borrow at cheaper rates than their peers, I think they should be the winners in the marketplace, and that is what is being experienced also. I think as far as the shift towards from ICE to EVs is concerned, I think in the two-wheeler space, we have seen incumbents have made a strong comeback, and I think the jury is still out there. And in the next few years, we will figure out as to who are the winners in the two-wheeler space. As far as the four-wheelers is concerned, I think it is still too early to call out the winners. So one should be cautious in this space because whenever technology changes, whenever the product changes, like in this case from ICE to EV, market shares can change. They can redistribute themselves. And I don't think it is uh, possible for me to say who are the futuristic winners. But whosoever wins in that space, the earnings growth in that space can be pretty decent. As far as AI is concerned, I don't think my understanding is either up to the mark or there are any obvious plays on that theme. I think companies that adopt AI, I think the early adopters of AI, the businesses that adopt AI, they should benefit by way of higher growth, better profitability, maybe even lower costs. But that would apply across sectors. Yes.
Typically, Mr. Jain, you've invested is that you typically like to buy companies or sectors where there is near-term stress, 2, 3 quarters, earnings may not recover, but when they recover, the stocks really get cheap. Can I say that that is the same logic why you've increased your exposure to consumer discretionary? Because in the public domain, whatever information we have, according to that, you have increased your exposure to consumer discretionary. So are you buying the stress in the consumer space to your advantage to add stocks?
I, don't think really, matlab, there can be small tweaks here or there, but as we discussed earlier, I think the consumer is slowing down because of you look at India's household net financial savings rate, it is quite low. The leverage is quite high. And so I think one needs to, and the multiples are still quite rich. So I would be, while there is definitely room for longer term growth in this space, and one would want to participate, but I think near term one should be a little cautious because the multiples are quite demanding. Yes.
Which you were explicitly bullish on. One was capex, second was manufacturing. Capex has worked like a charm for market men, whether it is ABB or whether it is a road company. But given that private sector capex is yet to pick up in a formidable manner, and government capex, because of this election year, is very slow, is the capex theme, which was dominated by surge in infra and capital goods stocks, is that over?
No, I don't think the cycle is over. I think there is considerable earnings growth here. In fact, see, these cycles take time to build and then they start running. And because capex by definition, from the time of from the intent to spend to actual spending can take 2 3 years. So I think private capex is improving. We should not lose hope. We should be a little more patient. And if you see the order backlogs of some of the engineering companies where the key customers are in the private sector, you are seeing very good order momentum and execution momentum. I think the issue is not the growth in this space. Growth, I think capex should grow faster than consumption for next few years, and which is good for the economy. The issue is how much of that growth is discounted, and I think in because this narrative is correct, and the narrative is widely understood, and what I have seen that whenever there is a strong, simple narrative, the markets extrapolate that narrative to an unreasonable extent and over discount that narrative. And I think that is what is happening in the manufacturing and capital goods space as well. So one should be cautious that what amount of growth is priced in. Yes.
Party in PSUs over. They were the ugly ducklings of the market. Then market cycle changed. They become the swans. From nobody wanted to buy PSUs, everybody wanted to buy PSUs, and now look at where they are.
I think it makes sense to look at PSUs like other businesses and so focus on right to win, focus on ability to compete, focus on realistic growth prospects, and what are we paying for that? I think there are very strong PSUs. They were there, they are there today. But today, the PSU theme, PSUs are not undervalued as a group anymore. They were undervalued post COVID because, as I think we have discussed earlier, most PSUs are in the economic sensitive sectors. There are no PSUs in consumer, in pharmaceuticals, in IT. And these were the sectors that did well in both business performance and in stock markets in COVID years. But core sectors of the economy where most PSUs are, they suffered. And that is why PSUs became extremely cheap. But as we know, as economy has recovered, as markets have recovered, as manufacturing has done well, as capex has done well, as banks have done well, these PSUs have also recovered. So I would say their valuations are in line with the rest of the markets, and one should not expect any meaningful divergence between PSUs and private companies. But still, one has to be careful as to what implied growth is there in PSUs. And where there is a mismatch, you can expect some more impact of that. Yes.
Specifically on defense, because that's a position which you had in your previous avatar, where you bought extensively and aggressively into some of the PSU defense stocks. Is that trend and one-time re-rating over? Have stocks now run up way ahead of what the actual earnings growth could be?
I think see, whatever become extremely popular tends to become somewhat expensive. So I would say these companies are certainly not undervalued anymore. They're extremely capable companies with the right to win, with good growth prospects. Government support is solid. These are very strong companies. But I would not be overexposed to that space. I would keep very realistic return expectations. And see, defense by nature, while you may get a lumpy order or large orders in a particular year, but the execution cycle of these businesses is typically 3, 5, 10, 12 years. So the growth is likely to be a lot more modest. Also, these businesses depend on supply chain, global supply chains. And since there are two ongoing wars, it is likely that some of these supply chains or supplies are getting disrupted. So I have really not assessed, I am not on top what is likely to be the impact of these disruptions on the near term growth rates as well. Yes.
You rarely talk, and this is Diwali show. So for someone who rarely talks, when he comes on a Diwali show, you have to leave our viewers a big thought in terms of trend, money making idea, or in terms of something which you are excited about as an investor.
What has worked is something very simple, that trust in Indian equities and be patient. And so I have seen the index come up from 2000 to 80,000. I think that compounding journey will remain. And so I think Mr. Buffett has said that stock markets are a device that transfer money from the impatient to the patient. So I think these are markets, classic markets for the patient investor. Focus on what you buy is reasonable quality, not overvalued, be patient, and have realistic return expectations. See a 12 or percent or slightly higher compounding over long periods can still create a lot of wealth. And I think that is what is realistic to expect in these markets. Focus on risk management as well. It is said that the best investments are made in the worst of times, like in the COVID times, and the biggest mistakes are made in the best of times. So I think this is also a market to reassess your portfolios and to look at valuations with respect to fundamentals and focus on risk as well at this point of time. Yes.
Really appreciate your time, Mr. Jain. Good luck for the coming Samvat year, and certainly hope to see much more of you going forward.
Thank you. Thank you, Nikunj, and wish you all the best too. Thank you.